What is climate finance, and why will it change your investing forever? In today's video, we'll explore what climate finance really means, why it's becoming one of the most important forces in the global economy, and how it could impact the way you invest. By the end of this video, you'll understand why climate finance isn't just about saving the planet. It's about unlocking entirely new opportunities for sustainable growth, resilience, and long-term wealth. Let's get started. First, let's define climate finance in simple terms. Climate finance refers to the flow of money, both public and private, aimed at reducing greenhouse gas emissions, adapting to the impacts of climate change, and supporting sustainable development. This includes everything from government funding for renewable energy projects to private investments in green bonds, sustainable infrastructure, and low-carbon technologies. In short, climate finance is the money moving to protect the climate and transform the economy. Now you might be asking, why should investors care about this? The answer is simple. Climate finance is reshaping global markets. As governments, institutions, and companies commit to net zero emissions and sustainable practices, trillions of dollars are being redirected away from polluting industries and toward cleaner, greener alternatives. That means your investments, whether in stocks, bonds, or funds, will increasingly be influenced by climate-related risks and opportunities. And ignoring this shift could mean missing out on the biggest investment wave of the 21st century. So, what are the key drivers of climate finance today? There are three main ones: government policy, investor demand, and technological innovation. First, government policy. Governments around the world are setting ambitious climate targets, such as the European Union's Green Deal or the United States Inflation Reduction Act. These policies create regulations, incentives, and subsidies that direct massive amounts of money into renewable energy, electric vehicles, and sustainable agriculture. Second, investor demand. More and more institutional investors, pension funds, and asset managers are demanding sustainable investment products. Why? Because climate change represents both a financial risk and a financial opportunity. Fossil fuel companies may face declining demand, stranded assets, or regulatory penalties, while renewable energy and clean tech companies may experience explosive growth. Third, technological innovation. Advances in solar, wind, batteries, hydrogen, and carbon capture are driving down costs and opening new markets. This creates investment opportunities in companies that can scale these technologies globally. Together, these three drivers, policy, demand, and innovation, are making climate finance a permanent fixture of global investing. Now let's break down the types of climate finance. The first type is mitigation finance. This means money spent to reduce or prevent greenhouse gas emissions. Examples include financing for wind farms, solar parks, electric vehicle infrastructure, and energy efficiency upgrades. The second type is adaptation finance. This means funding projects that help communities adapt to the impacts of climate change. Examples include building flood defenses, designing climate-resilient agriculture, and strengthening water management systems. The third type is just transition finance. This ensures that the move to a low-carbon economy is fair and inclusive, supporting workers and communities that depend on high-emission industries. Together, these categories cover the entire spectrum of climate-related investment. But where is this money actually coming from? Climate finance flows from a mix of public and private sources. Public sources include government budgets, international climate funds, and development banks. Private sources include institutional investors, commercial banks, insurance companies, venture capital, and even retail investors like you. In fact, one of the fastest growing areas of climate finance is the green bond market. Green bonds are debt instruments issued to fund environmentally friendly projects. In just over a decade, the global green bond market has grown from almost nothing to more than $2 trillion in outstanding value. This explosive growth shows how mainstream climate finance has become. But it's not just about bonds. There are also sustainability-linked loans, carbon markets, green equities, ESG funds, and climate-focused ETFs. This diversity means investors have multiple entry points to align their portfolios with the climate transition. Now, here's where it gets even more interesting. Climate finance is not only about protecting the planet, it's also about managing risk and capturing new growth. Let's talk about risk first. Climate change is now recognized as a systemic financial risk. This means physical risks like floods, wildfires, and hurricanes can directly damage assets and supply chains. It also means transition risks, like stricter carbon regulations or consumer demand shifts, can devalue fossil fuel companies or carbon-intensive industries. For example, think about coal. In the past decade, coal has gone from being a dominant energy source to one of the riskiest investments, as countries phase it out to meet climate targets. Investors who failed to account for this risk lost billions. On the flip side, those who recognized the transition early gained exposure to renewables and sustainable energy leaders. That brings us to opportunity. According to the International Energy Agency, achieving net zero by 2050 will require more than $100 trillion in cumulative investment. That's a once-in-a-lifetime opportunity to invest in clean energy, sustainable infrastructure, and climate solutions. For investors, this could mean significant returns in industries such as solar, wind, electric mobility, smart grids, and energy storage. It also means growth in related sectors like sustainable agriculture, water technology, and green real estate. In other words, climate finance is not just a moral imperative, it's a financial revolution. So how can individual investors take part in this? Let's go through a few practical steps. First, learn about ESG and climate-focused investment funds. Many asset managers now offer funds that integrate climate considerations or focus specifically on sustainable companies. Second, explore green bonds or sustainability-linked bonds, which are increasingly available to retail investors. Third, research companies directly. Look for firms with strong climate strategies, low emissions profiles, and exposure to clean technologies. Fourth, engage with your financial advisor or broker. Ask them about climate finance opportunities and how your portfolio can be aligned with the net zero transition. And fifth, stay informed. Climate finance is evolving rapidly, with new products, policies, and opportunities emerging all the time. Now, you might be wondering, is climate finance really profitable? The short answer is yes, but with nuance. Like any investment area, there are risks. Not every green technology will succeed, and not every ESG-labeled fund delivers strong performance. But overall, studies show that companies with strong sustainability practices often outperform their peers in the long term. Why? Because they manage risks better, innovate more, and are positioned to thrive in a low-carbon economy. For example, renewable energy companies have seen declining costs and rising revenues, while oil and gas companies face mounting volatility. Investors who allocate strategically to climate-friendly assets can both reduce risk and capture growth. So yes, climate finance can be profitable, and increasingly, it may be essential for long-term wealth protection. Let's zoom out and think about the big picture. Climate finance is not just a niche trend. It's becoming the new normal. Central banks are integrating climate risks into financial stability assessments. Regulators are requiring companies to disclose climate-related risks, and global institutions are setting targets for sustainable finance flows. In fact, the Glasgow Climate Pact calls for developed countries to mobilize at least $100 billion annually in climate finance to support developing nations. This shows that climate finance isn't optional, it's embedded in the future of global markets. And that means your investments will be shaped by it, whether you realize it or not. The choice is whether you embrace this change early or risk being left behind. To wrap up, let's recap the key points. Climate finance is money flowing to climate solutions and low-carbon transitions. It's driven by government policy, investor demand, and technological innovation. It covers mitigation, adaptation, and just transition. It comes from both public and private sources, and it's creating new financial products like green bonds and ESG funds. It helps investors manage risk and unlock opportunity, and most importantly, it's reshaping the entire landscape of investing. So the real question is, will you position yourself for the future or hold on to the past? Because climate finance is not just about saving the planet, it's about transforming the way we build wealth, and it will change investing forever. Thanks for watching Money and Planet. If you enjoyed this video and want more insights on sustainable investing, ESG, and climate finance, make sure to subscribe, like, and share. Together, we can build wealth and a sustainable future.